Most people who invest their first $1,000 lose it. Not in some dramatic crash, not in some Ponzi scheme, not because the market collapsed. They lose it slowly, quietly, to fees they didn't read about, to decisions they made at 11 p.m. when the chart was pointing up, and to the single most expensive mistake in retail investing. They were impatient. Pause. Let's sit. Here's the thing. $1,000 in the market is not a retirement plan. It is not a life-changing event. It is not the beginning of some rags to riches arc. But it is something. It's a decision. And most people get it wrong in the first 30 days. So this is not a video about getting rich. This is a video about what I'd actually do, specifically, mechanically, honestly, if I had $1,000 entering the market for the first time. What I'd buy, what I'd avoid, and why the most boring answer is almost certainly the correct one. Stay with me, because the math at the end of this is going to make you slightly uncomfortable. Tone shifts, measured, almost clinical. Let's start with context, because context is everything. Right now, in 2025, the average American household has roughly $8,000 in liquid savings. The median is closer to $600, which means for most people, $1,000 isn't just a starting point. It's a significant portion of what they have. At the same time, the S&P 500, the index that tracks the 500 largest companies in the United States, has returned an average of roughly 10% per year over the last century. Not every year. Some years it drops 30. Some years it rises 28. But over long stretches, that average holds. So here's the obvious pitch. Put your money in, let the market do its thing, become wealthy over decades. Simple. Except it isn't simple. Because humans are involved. And humans are catastrophically bad at this. A brief, deliberate pause. Studies consistently show that while the S&P 500 returns around 10% annually, the average retail investor captures somewhere between 3 and 5%. The rest evaporates. To bad timing, to panic selling, to chasing trends, to the very human tendency to do something when the right answer is usually do nothing. That gap between what the market returns and what investors actually capture is called the behavior gap. And it is the single most important concept in personal finance that almost nobody talks about. So before we talk about what to buy with your first $1,000, we need to talk about the enemy. And the enemy is you. Not dramatically, not insultingly, just statistically. Energy picks up slightly. Now we're building something. Okay, you have $1,000. It's sitting in your bank account. What do you actually do? Step one, and I cannot stress this enough, is make sure this money is genuinely spare. Not rent money, not emergency money, not the thing you're counting on in 3 months. If your financial foundation has any cracks in it, $1,000 in the stock market is not the move. A high-yield savings account paying around 4 or 5% annually is. Build the foundation first. If, however, you do have that foundation, solid emergency fund, no high-interest debt, then we proceed. First decision point. The first decision is where to put it. And this is where most first-time investors immediately go wrong. They open an account, they look at the list of individual stocks, and they think, I need to find the right company. The one that's going to go up. The next Apple or the next NVIDIA or whatever name is in the headlines that week. This is the wrong instinct. Not because picking individual stocks is impossible. Some people do it well. But because the evidence suggests that the vast majority of professional fund managers, with decades of experience and teams of analysts and access to information you will never have, fail to consistently beat the market index over a 10-year period. Around 80 to 90% of them, depending on the time horizon, underperform a simple index fund. Let that absorb for a second. The professionals, the ones paid millions to pick the right stocks, mostly can't do it reliably. So what is an index fund exactly? Think of it this way. Imagine you want to bet on the American economy as a whole, not on any one company, but on the broad idea that the country's biggest businesses will, collectively, be worth more in 20 years than they are today. An index fund is how you make that bet. It holds small pieces of hundreds or thousands of companies. When one fails, it barely matters. When one explodes upward, you participate. The whole thing rises and falls with the market itself. The most famous version of this is a total market index fund, or an S&P 500 index fund. Vanguard, Fidelity, and Schwab all offer versions of these. The expense ratios, that's the annual fee they charge, are often as low as 0.03%. Not 3%, 0.03. That's 3 cents per $100 per year. Compare that to the average actively managed fund, which charges around 1%. Same ballpark, very different impact over 30 years, and we'll get to that math shortly. Second decision point. So you've picked your fund. Now, what account do you put it in? If you're in the United States, the most powerful vehicle for long-term investing is the Roth IRA. You contribute after-tax money, and every cent of growth, every dividend, every capital gain comes out tax-free in retirement. On $1,000 compounding for 30 years, that tax shelter is potentially worth more than the original investment itself. The contribution limit is $6,500 per year as of the most recent guidelines, so your $1,000 fits easily. And you could open one in about 20 minutes with any major brokerage, Fidelity, Schwab, Vanguard. If you're outside the US, the equivalent concepts exist. ISAs in the UK, TFSAs in Canada, superannuation structures in Australia. The principle is the same. Use the tax-advantaged wrapper. Always. Third decision point, the actual allocation. Here's what I would personally do with $1,000 as a first investment. I would put the entire $1,000 into a single total market index fund. Not split between 10 different things. Not a mix of bonds. Not some allocation spreadsheet. One fund. The whole thing. Why? Because at $1,000, diversification within the investment is already solved by the fund itself. You own fractions of hundreds of companies. Adding complexity adds no benefit. It just adds decisions. And decisions are where the behavior gap lives. I would then set up automatic contributions, even $25 or $50 a month, and I would not check the balance more than once a quarter. Ideally less. That sounds anticlimactic. I know. The internet told you to find the next 10x stock. The influencer on your feed told you he turned $300 into $40,000 with options. We'll get to him later. But first, the math. Slow down. Almost conversational now. Let's be very honest about what $1,000 actually does. At 10% annual return, that historical market average, $1,000 becomes roughly $1,611 in 5 years. After 10 years, $2,593. After 20 years, $6,727. After 30 years, $17,449. $17,000 from a one-time investment of $1,000. That is genuinely impressive. That is compound interest working exactly as advertised. Einstein may or may not have called it the eighth wonder of the world. The quote is probably apocryphal, but the math is real. Now, let's add the thing they don't show you on the thumbnail. Inflation. The dollar you have today is not the dollar you'll spend in 30 years. At a 3% average inflation rate, roughly the long-run U.S. average, that $17,449 in 30 years has the purchasing power of about $7,200 in today's money. Still good. Still meaningful growth. But not the staggering number the headline suggested. And now the fees. If you're in a low-cost index fund at 0.03% expense ratio, the impact is negligible. We're talking a few $100s over 30 years. But if you wandered into an actively managed fund at 1%, you've just handed the fund company roughly $4,000 to $5,000 over that same period. That's money that never compounded. That's the invisible tax on mediocre advice. This is the crux. Hold it here. And then there's taxes if you're not in that Roth IRA wrapper we talked about. Every time you sell something in a regular brokerage account, the government takes its share. Capital gains tax, dividend tax, the works. Over a long holding period in a taxable account, this can reduce your effective return by another 1 to 2 percentage points annually. So the real math, after inflation, after fees, after taxes in a non-advantaged account, looks less like a tripling and more like a decent but modest outcome. Still better than a savings account. Still better than doing nothing. but not the life-changing event the thumbnail implied. Here is what is life-changing. Doing this consistently. Every year. For decades. Not $1,000 once. $1,000 as the start of a habit. If you invest $1,000 a year for 30 years at that same 10% return, you end up with roughly $180,000. That's the actual math, not magic. Patience plus consistency. The problem is patience is boring, and the internet is not built for boring. Slight edge in the voice here. Not cynical, just clear-eyed. Let's talk about the other options. Because you've seen them. We all have. The trading account, the options plays, the crypto portfolio, the hot stock tip, the guy on YouTube who started with $600 and now drives a rented Lamborghini in front of a rented mansion, which, to be fair, at least has the honesty of 2 rentals in close proximity. Here is what is true about active trading with small amounts of capital. The friction kills you. Options, the financial instruments that give you the right to buy or sell an asset at a certain price, can amplify returns dramatically. A $100 option contract can double or go to zero in a week, which sounds exciting until you understand that most retail options traders lose money. A 2021 study by the broker Tasty Trade found that the majority of retail options buyers, not sellers, buyers, lost capital over time. And with $1,000, you're not just dealing with the math. You're dealing with the psychology of watching a position move 20% in a day. Most people cannot handle that without making at least one catastrophic emotional decision. Crypto. Let's be precise here. Bitcoin has, over its lifetime, been one of the best performing assets in history. It's also had drawdowns of 80%. 80%. If your $1,000 dropped to $200, could you hold? Not sell? Not panic? Most people say yes and discover, when it actually happens, that they were wrong. The asset is real. The volatility is real. The question is whether your psychology can absorb both. For a first investment, probably not the place to learn. Gentle irony. Let it breathe. There's also the phenomenon of social media investing. The Reddit posts, the Discord servers, the influencer who says he turned 1,000 into 10,000 in a month. Sometimes that's true. Sometimes it's survivorship bias. You hear from the one person who won, not the 900 who quietly lost. Sometimes it's outright fabrication. The lines blur quickly in that space. What you almost never see on social media is the boring truth, that the people consistently building wealth in the market are mostly invisible because they're not doing anything interesting. They're sending money to an index fund every month and watching television. Boring is not a bug. Boring is the strategy. Now, there is one exception worth acknowledging. If you have a genuine edge, specific industry knowledge, a professional background that gives you real insight into a sector, a genuine willingness to do deep fundamental analysis over years, then a portion of your portfolio in individual stocks may make sense. Not as a gamble, as an informed bet with a thesis and a time horizon. But that is not most people, and it is almost certainly not the right move for a first $1,000. Zoom out. Almost philosophical, but grounded. Here's something worth sitting with. The stock market is not a casino, but it does have a casino-like quality in the short term. Prices move on sentiment, on news cycles, on geopolitics, on the Federal Reserve, saying 7 words that were slightly different from what people expected. In any given day, week, or month, the market is largely noise, but zoom out to decades and something shifts. The noise fades. What's left is the underlying engine. Businesses making products, people buying things, technology compounding, population growing, productivity increasing. The long-run trend of capitalism, for all its messiness and inequality and periodic catastrophic failures, has been upward. Your $1,000 is a bet on that trend continuing. That's all it is. Not on a specific company, not on a specific CEO, on the general idea that the world, over the next 30 years, will be doing more commerce than it does today. That's not guaranteed. The 20th century had 2 world wars, a Great Depression, the Cold War, oil shocks, stagflation, the dot-com crash in 2008. And through all of it, the market's long-run trend held. That's not comforting precisely. It's just the data. But here's the risk they understate. The biggest risk for a new investor is not picking the wrong stock. It's picking the wrong time horizon for their own life. If you invest $1,000 today and you genuinely need that money in 18 months for a car, for a house deposit, for an emergency, you are exposed. Markets can fall 30% and stay there for a year or two. If you need to sell into that, you crystallize the loss. The market rewards patience almost unconditionally. It punishes forced selling almost unconditionally. The difference is not intelligence. It's just time, which is why the single most important thing I do with my first $1,000 has nothing to do with what I buy. It's understanding genuinely and concretely that this money does not exist to me for the next decade at minimum. It's gone. It's in the market. I've accepted that. The investor who does that, really does that, not just intellectually but emotionally, will almost always outperform the investor who's technically smarter but checks the balance every morning. There's also something worth acknowledging about the system itself. Not in a conspiratorial way, just an honest way. The financial industry is structured in many places to monetize your anxiety. More trading generates more fees. More complex products generate more margin. The advisor who tells you to put everything in an index fund and check it quarterly does not generate much revenue. The one who sells you a managed fund with 5 moving parts generates quite a lot. Incentives matter. Know whose interests are aligned with yours and whose are not. Low-cost, passive investing is not exciting. It is also, in aggregate, what the evidence consistently supports. That's an awkward sentence for an industry worth trillions of dollars to acknowledge. Quieter now. Deliberate. Let the camera breathe. So, $1,000 in a Roth IRA or your country's equivalent tax-advantaged account. In a total market index fund with an expense ratio under 0.05%. Automatic monthly contributions, however small. No individual stocks. No options. No checking it every week. A time horizon measured in decades, not months. That's what I would do. And I want to be honest with you about what that actually produces. Not the viral version. Not the compound interest chart that starts small and ends in a vertical line that seems to defy gravity. The real version. $1,000 today, left alone for 30 years at historical average returns, adjusted for realistic inflation, becomes something meaningful. Not yacht money, not retirement on its own, but meaningful, a foundation, the beginning of the habit that is actually the whole point. Because here's the thing about your first $1,000 in the market. It's not actually about the $1,000. It's about what happens next. Whether you add more, whether you stay the course during the inevitable 30% crash that will come at some point, origin unknown, timing uncertain, guaranteed in some form over a long enough horizon. Whether you can watch your balance, say $700 where it once said $1,000 and do absolutely nothing. Most people can't. That's why most people underperform. Not because they don't understand compound interest, because they feel things when the number goes down. There's no hack for that. No app, no algorithm, no financial product that solves for human psychology. The only real edge available to an ordinary investor is time plus consistency, plus the discipline to be boring in a world designed to make you impulsive. A breath. The last turn. I'll leave you with something I think about more than I probably should. Every generation of investors has inherited a market that looked, at their entry point, more expensive and more risky and more uncertain than any previous generation. Every generation has had genuinely good reasons to wait, to hold off, to see how things develop first. And the investors who waited broadly did worse than the ones who started anyway, imperfectly, early with incomplete information, and then stayed. I don't know what the market does next year. Nobody does. I don't know if we're at the beginning of a decade-long bull run or 3 months from a painful correction. The honest answer is that no one on the internet, no one in a suit on television, no one with a verified account and a conviction actually knows either. What we do know is that the question was never really about the money. It was about who you are when the money is doing something you didn't want it to do. Figure that out, and the $1,000 almost takes care of itself.